Welcome to Forbes Talks. I'm John Dobosz, joined by my Forbes colleague, Hank Tucker, markets reporter and money and investing extraordinaire. We're talking today about the very steep stock market sell-off occurring on Monday, August 5th, which follows up on the heels of Thursday and Friday, which were sharply down days for U.S. stocks. Overnight, the Japanese Nikkei index had its worst single day since 1987, down 12%. South Korea COPSI was down 10%. These are extremely large one-day moves that you don't usually see in a stock market. So, Hank, what is behind all of this? We know that the interest rates in the United States are on the verge of coming down. The Fed declined to do it in July. It seemed like everything was okay on Wednesday, and the bottom fell out on Thursday. What's your read about what's been going on?
Yeah, Thursday was a pretty weak day, and then I think the jobs report that came out on Friday that showed a weaker jobs market, that the unemployment rate was higher than expected at 4.3%, spooked investors as well into Friday, and then they had all weekend to get a little more anxious and worked up, I think, and today at the open it was down as much as 4%. Now as today's gone on, it's gotten a little bit better. Now we're only down a little over 2% in the S&P 500. Compared to some of those, really bad crashes in Japan and South Korea that we're seeing overseas. So, overall, as market crashes go, this is, pretty tame. Obviously, 2 or 3% is pretty, not nothing to sneeze at. But we're still only down 8% or so from the all-time highs of 3 weeks ago. But that's also making, investors and experts I'm talking to, not really willing to buy yet. They don't really think it's much of a buying opportunity. The valuations are still pretty high. So, we'll see how long this lasts.
The months of October, I'm sorry, the months of August and September are traditionally pretty weak. October has the very nasty reputation for what it's done in the months of October of 1929, October 1987, and times like that. But more often, these declines, when we get them, start around this time of year, mid-hurricane season, and then hit their nadir, or hit the peak of pain in October. So there is some seasonality that's involved, but as far as stock market declines go, there's bear markets and then there's just corrections. What's the difference between the two? 20% is the threshold for a bear market?
Yeah, 20% is typically thought of as a threshold for a bear market. And as I said, we're still a long way away from that. We're only down, 8 or 9%, depending on when you look this morning. And a correction is typically thought of as around 10%. So we're pretty close to a correction. It's a real pullback. But if this becomes a bear market and this is a real recession we're heading into, as some are concerned about, then there could still be a long way to go for that.
I just looked this up today that there have been 38 market corrections since the 1950s. So they occur about every 1 or 2 years. As you said, 10% or more decline from the peak. And then they last for about, the worst of it is over 6 weeks to 2 months later. And they're typically, the market is hitting new highs 4 months after a correction hits. So, it's hard to argue, though. You weren't around maybe in the 1999 buildup, but you could just replace the word internet with artificial intelligence. And, it was just like, there's nothing we can't do with AI. Oh, and NVIDIA was going to the moon and taking a bunch of the Magnificent Seven with it. So you had this, let's not forget, even after the big declines, those stocks like Microsoft and Meta Platforms, even Apple, is up really nicely for the year. 20 more than that for NVIDIA, but even those other large cap techs are up like 20% or more still for the year.
Yeah, I mean, NVIDIA has just about doubled still, even after a decline today and for the last month of, I think around 30%. That stock, it's still, if you bought it a month ago, then you're not
You're
feeling.
bumming, but if you bought it 6 months ago, you're still in heaven.
It's still golden. So yeah, as long as I don't think a lot of long-term investors are really sweating too much yet. But still, this decline over the last week or so, it's wiped out, around 2 months of gains, which is very kind of just a blip, as long as it doesn't snowball into, more panic, more anxiety. We'll see what the Fed does to kind of stabilize and calm people's fears. People are expecting a rate cut at their next meeting in September, if not sooner. But yeah,
And that would
overall,
be wouldn't that be a huge red flag to throw up by the Fed to say, oh my God, things are so bad, we needed to cut rates before our next meeting?
yeah, I think that could be counterproductive and just make people freak people out more a little sooner. So I wouldn't expect them to do that. But we'll see how things unfold the rest of this week.
The direction of the Japanese yen versus the US dollar also plays a role. I've been hearing a lot about the carry trade. The carry trade is when you borrow in a currency with low interest rates relative to the country where you want to invest. And people have been doing this by borrowing in yen denominated debt and then buying US assets, whatever they are, the Mag 7 stocks. And that's fine as long as the yen keeps on going down against the dollar. But that trend has broken. And now the yen is going back up against the dollar. The Bank of Japan is holding rates steady or hiking moderately, and you have the Fed on the verge of massive rate cuts. So that unwinding is, if we're to believe it, on the institutional desks of the world, a big deal.
Yeah, and that's certainly hurting the Japanese market, as you mentioned. It's not maybe it doesn't reach the level of a Black Monday in the U.S., but it certainly was in Japan with a 12% decline, as you mentioned at the start of this call, and so that certainly qualifies as a pretty major crash over there. And I think there's a saying that when the U.S. sneezes, the rest of the world catches a cold, or if the U.S. has a cold, the rest of the world has pneumonia, and that's kind of playing out certainly in Japan and in South Korea, and the specific factors of what's going on over there with the yen getting a lot stronger. Their central bank, as you mentioned, starting to hike interest rates has made that effect really amplified in Japan. But they had been one of the darlings of the market for a few months, and they had been really an outperformer. But this today wiped out the whole year's gains. Friday and today wiped out the whole years of gains in the Nikkei index so far. So not good news for investors in Japanese markets. The rest of the world, it's kind of wait and see, and they all have their eyes on the U.S. and what happens here.
There are some places traditionally that you can hang out during bear markets or corrections, or if you just want a lower volatility ride on stocks, the consumer staples sector. You had Coca-Cola, I think, on Friday or Thursday of last week, hitting a new all-time high. There was news today that the Mars company, which makes Mars bars and other chocolate bars, is looking at buying Kellanova, and their stock was up like 14%. But those stocks like Clorox or Campbell Soup, Hormel Foods, Tyson Foods was up today about 4%. They tend to hold up better. They don't have the gains that these market darlings do on the uptrend, but they don't kick you quite as hard on the downside either.
Yeah, they could definitely be safe havens if you're more of a bear, more of a pessimist, and think you're a little worried about a recession coming. Those are definitely places that you could kind of wait this out. Utility is also a sector that usually does well
They've
in
done well in the last 2 weeks for
yeah.
sure. Yeah. How about just money market funds? You're still making a 5% yield until the Fed craters that later on, but there's no shame in that.
Yeah, I mean that will only last probably maybe another month or two until they start cutting those rates. But yeah, for now, if you want a 5% annualized yield and are worried about this the valuation still being pretty high, I think investors still don't really see this as a buying opportunity. So if you have a good reserve of cash that you want to put to use in a bear market, maybe you wait a little longer for the market to be down, maybe 15-20% from the peak instead of where it is now, and keep getting that 5% in your money market account. And then, by the time rates are cut and that interest rate starts going down, maybe the SP 500 will be a more attractive place to be to start plowing that money into.
And let's not forget, the stock market's not really a place to have your utility bill or next month's rent or something like that. So it's a 4 to 7 year general game. You've been rewarded much more quickly than that in the past few years, but generally you shouldn't put in money to the market that you don't need, that you're going to need for the next 4 to 7 years. But in the long run, you know, a person today who's 25 or 30 years old, when they're 60 or 65 years old, will look back. Remember that day that the carry trade unwound? No, they won't. You know, this is kind of a blip in an upward trend. Any other words of wisdom that, you know, we both talk to billionaires who manage money and stuff like that. What it seems to me though, they never really give you a clear answer on where they think the market is going, unless they're no good and they just want to make a name for themselves. But have you heard anything on the, you know, all the billionaires that you talk to?
You know, I haven't heard much of substance. You know, they I guess they keep a lot of their best secrets to themselves. But no, I think there is some real concern about you know, the economy. That I think they always want to qualify, you know, be cautiously optimistic if they are optimistic. But no, that I mean, that obviously. You know, things have slowed down this year, and over the last year or two, and inflation's gotten worse. It is starting to get a little better, come down from that trend now. But everything we hear about in the political campaign, the election season, you know, some of that is real, that people are feeling the price hikes. But no, I think it always comes down to everyone wants to quote Warren Buffett and you know, be greedy when others are fearful. And so I think that a lot of them will find, you know, a good buying opportunity, if not now. And Buffett himself has sold, you know, a lot. He's sold, I think, half his Apple stake,
Half of his Apple. He might be a little fearful now though too. So
yeah.
maybe
So he is starting. He's got $277 billion of cash that's he's waiting to deploy somewhere. So you know, if you think he's really smarter than we all are, maybe, you know, you are a little more cautious now,
right.
until um you get that signal from him. But yeah, you know, if that's the case, then, you know, 5% in cash now is you know, not a bad move. But you know, again, over the long term, you know, if you zoom out 5 years, this is just a tiny blip, and we're still higher than we've been at almost any other point in history, other than the last 2 or 3 months. So you know, I don't think it's a time to panic.
As Buffett points out, it's best to own productive assets over other things in the long-term history. As long as the population keeps growing, as long as we keep on doing business with each other, the market really, in the long run, is only it's only higher.
Yeah. So, you know, if you're my age, if you're 27, you know, even if you're you know, my
Even 56 works out in this market.
yeah, yeah, yeah. Just, you know, don't panic, don't sell, because, you know, if you sell on a day like this, or on a week like this, and you miss out on the, you know, 10-20% upturn that comes, a lot of times you don't get that back.
Successful market timing requires knowing when to get out and when to get back in. And most people just, once you've freaked out and thrown in the towel, you're really not going to be so bold to catch stocks right at the bottom, because you'll still be overly fearful. Good stuff, Hank. Thanks a lot.
All right, thanks, John.
That's Hank Tucker from Forbes. I'm John Dobosz for Forbes Talks.